Hello and welcome. My name is Raymond Gibbons from BMS Accountants in Navan, County Meath. And today I want to talk to you about managing that critical element of your business called cash. Cash flow management is critical to ensure the long-term survival of your business. So I've prepared a short video entitled Managing Your Cash, which I hope will give you some benefit and some useful tips on how to manage your cash flow. So without further ado, here's the video.
So let's begin the presentation. We know that for many business owners, cash flow is the number one stress that they will face on a constant basis. This can be for many reasons, but for example, falling revenue and sales, falling margin, increased costs in running a business, perhaps they're not getting paid on time for invoices that they've issued. Bad debts may be increasing, and as we know, access to credit lines is proven more difficult as banks and other lenders require budgets and business plans, etc., just to avail of what we would have called the normal cash flow requirements for a business, which might have been a small overdraft. As business owners, we also find that there are constant demands on our cash, and it seems to be that cash is going out of our businesses more quickly than cash is coming in. So in this presentation, to help us understand just what's involved in managing your cash flow, we're going to look at the following. We're going to try and explain just exactly what is cash flow. We're going to take a look at working capital, ways to improve your cash flow, how to design and implement a credit control procedure, and how to improve your own internal procedures to speed up payments from customers, how to manage your cash outflows, and how to spot those warning signs that might be an indicator of pending problems with your cash flow. So to help us try and understand what we mean by managing cash flow, I wanted to use an example of a water tank, where the water that's in the tank now is what we're going to refer to as the cash in hand. This cash in hand is topped up by cash inflows. Cash inflows is cash generated from sales and other funds that you might invest in the business from personal savings. Cash outflows, on the other hand, are strains on our cash flow. These are business overheads that need to be paid out of the cash that's in the water tank. And the objective here is clearly to ensure that there's sufficient funds in the water tank to pay and meet those bills. So it's fair to say that businesses are generally systems for generating cash. The water tank, in the example that we've just looked at, must not be allowed to run dry. It's constantly topped up by receipts from customers, which we use to pay suppliers, wages, and to buy capital equipment if we want to expand our business. In a business startup situation, it's normally the responsibility of the entrepreneur who will fill up the water tank at the outset of the business. This is done by borrowing money from lenders or by perhaps investing in their own personal savings. As SME owners, what we tend to find then is that the tank refills slower than it empties. We tend to give longer credit terms to customers, either subconsciously or intentionally. Bad debts may arise, but we tend to find that we're paying out money quicker than money is coming in. This is what we refer to as the cash flow gap. So let's just talk about the cash flow gap for a couple of minutes. We've already identified that it refers to cash being received at a slower rate than cash is being paid out. And this is fine provided you're profitable and receiving more money than you are paying out. But even profitable businesses can fail because they run out of cash. This is because many businesses focus on profit and not on cash flow, which are two distinct things, and we will identify that as the presentation goes on. Equally, many SME owners in particular ignore proven credit control procedures. They accept late payments from key customers because they're afraid to lose that customer, and this in the long term can prove disastrous. Again, many business owners ignore the relationship between costs and revenue. Ask yourself the question, do you know what costs drive your sales? Are you carrying unnecessary overheads? Do you focus on reducing your costs? Also, we find that many business owners overstock. They carry far too much stock for the size of their businesses, and over time stock will depreciate in value or become obsolete, and then we're left with stock that is of a lower value than what we paid for it, and this clearly is not the ideal situation. Heavily geared businesses, even if profitable, may not be able to service loan repayments. So what do we mean by this? A heavily geared business is a business that has high debts. You might have borrowed to expand your business by buying another retail outlet rather than renting. And even though your business on paper is profitable, you might find that there's insufficient cash generated to service the loans. So in summary, by understanding what we mean by the cash flow gap, we can see that cash flow management is all about putting in place critical controls to manage that most critical of resources, cash. We do that by effective management of the cash inflows and outflows of a business. We also do it by striking the correct balance to ensure you have sufficient cash in your bank account before you pay your bills. In essence, we ensure that we keep the water tank from running dry. Next, I would like to talk to you about working capital. Don't be afraid of this term. In accounting terminology, it's the amount of cash tied up in trading assets which are expressed as current assets less current liabilities. Or put more simply, the total of cash plus stock plus debtors less trade creditors. Simply put, it's ensuring that we have enough cash to pay our bills as and when they fall due. Working capital, therefore, is a measure of liquidity of a business. But first, why worry about working capital? Surely it's just an accounting term. Why monitor it? Well, we do this for a number of reasons. Firstly, it's about timing, making sure we receive money in time to pay the bills that are falling due. You may be profitable, but still struggle to pay the bills on time, as we pointed out earlier, because profitability and a strong cash flow do not necessarily go hand in hand. If you're a sole trader, are you taking out excessive drawings because of your lifestyle expenses? Are you behind in your taxes? We came out of a very tough recession. Did you put a payment plan in place with revenue to pay tax arrears, but only to find that you got insufficient cash to keep your current taxes up to date? Are key customers slow paying you because your own internal systems and procedures are not up to speed? Or did you try and grow too fast coming out of the recession and find that cash is not stretching as far as you would like it to? So when we refer to monitoring working capital, what we're actually talking about is monitoring cash, debtors, stock, and creditors to ensure that we have sufficient cash to pay our liabilities on time. So we now know why we monitor working capital, but also we know what working capital is. That is, that's the difference between your current assets and your current liabilities. As such, it can be positive or negative. If working capital is positive, it means that we have more assets than liabilities, which means that we should be able to pay off our liabilities if our creditors put a squeeze on us to do so. But is positive working capital a good or a bad thing? Well, in truth, it depends on the makeup and the quality of your current assets. That old saying of cash being king has never been more true, or was never more true, in the recession that we just faced. Debtors, on the other hand, are not necessarily a good asset to have, particularly if you're not chasing down slow-paying debtors. The high value of debtors might look good when it bumps up the value of your current assets, but if they're slow paying you, well then it's not a particularly good asset. Equally, stock. If you're carrying high levels of stock that you're not selling, well then this is a bad use of cash. So let's take a closer look at debtors and stock. If you have a high volume of debtors on your books, you need to ask yourself some key questions. What is the age of the debtors on your books? Are they old? The older the debt, the more likely there is a chance of non-payment. Is the age of your debtors reducing or increasing? What is your reaction to slow paying customers? Do you ignore them because you're afraid of upsetting key customers? Are you heavily dependent on one or two customers? And if so, do you have a strategy in place to expand your customer base to reduce that dependency? Do you have a credit control policy in place? And if so, do you implement it? Do you do background checks on all new customers to determine whether or not they have a reputation for non-payment of their debts? And what percentage of bad debts do you have on your books year on year? When it comes to stock, you need to know the level of stock you're carrying. And more importantly, you need to know the value of the stock you're carrying. Is the stock value up to date? Is it based on new stock, or is it old stock? And if it's old stock, what's the likelihood that you're going to be left with this stock and unable to sell it? Is the resale value of the stock less than what it cost you to buy it? How good is your reordering? Do you order on a just-in-time basis? Or is your ordering a little bit more ad hoc, resulting in higher stock levels than you actually need? How many times a year does your stock actually turn over? The higher the stock turns, the better. This would mean that your stock is generating cash quickly. What is the industry average for stock turns in your particular industry, and how do you compare it to that average? To finish on this particular section, I just want to briefly talk about negative working capital. That's where the value of assets are less than the value of liabilities, or in other words, we have more short-term debt on our books than short-term assets. During the boom times, many SME owners were encouraged to actually have negative working capital. It was very popular with many business theorists and very popular with their accountants at the time. In fact, it was so highly recommended because it was seen as the most efficient way to manage your working capital. But in truth, a company would have to be very profitable and have strong cash inflows to be able to manage negative working capital. And it only really suits a business that is generating cash very quickly, such as a grocery store. So beware. In general, having a negative working capital, that is where your short-term liabilities are greater than your short-term assets, would indicate the business's inability to pay short-term debt, particularly if creditors put a squeeze on you for payment. So when it comes to SMEs, I would recommend that when you're looking at your working capital, the ratio you should consider is about 1.5:1, and that is where your current assets are 1.5 times your current liabilities. So let's move along now, and let's see if we can look at ways to improve your cash flow, which is what this presentation is really all about. So we know that to manage your cash flow means you need to be on top of your current assets and current liabilities. From your current assets perspective, the longer it takes for debtors to pay you, the more strain on your cash flow and the higher the risk of bad debts. From a stock perspective, if you've got too much cash tied up in stock, it's a waste of a critical resource, cash. Creditors. Try and maximize your credit terms with suppliers and increase those credit terms if possible. Let's take a closer look at debtors and ways to improve cash inflows by improving your management of debtors. We know that the key risk from a debtor's perspective is slow or non-payment of your invoices. This can impact on your ability to secure stock, pay your own bills such as wages, rent, overheads, or to repay loans. So ask yourself the question, how well do you know your customer base? Have you done your research on your customers? Can you speed up payments from customers by offering incentives to pay early? So how quickly do you raise your invoice to your customer after you make a sale? And how quickly do you enter that invoice onto your own account system to ensure that the balance on the customer account is up to date? Because when you send out customer statements at the month end to try and get payment from your customers, you at least want to know that the balance that you're asking them to pay is correct. So of course, one way to ensure there are no bad debts and there are no late payments is to insist on cash on delivery. COD works every time, but in reality, most businesses will have to carry debtors to carry on trading. To spread your risk, continuously seek new business and new accounts. As your business matures, your customer base should get stronger, which means that you will no longer have a dependency on one or two critical customers. So by growing your business and spreading your risk, you will eliminate the impact that one customer will have if he or she defaults on you. When you take on new customers, make sure that you vet them carefully and that you manage their accounts from the very beginning. Ensure that they have a reputation for payment on time. How do we get this information? Well, we construct a robust credit control policy, and that's what we're going to look at next. The purpose of your credit control policy is to reduce the risk of non-payment by customers. So here are a few tips to develop a credit control policy that will be robust enough to ensure that you get paid on time. For new accounts, design a new customer setup form where you can request critical information to do background checks on your new customer. Ask for and check trade references to ensure they pay their suppliers on time. Use a company to do a background check on new credit customers to ensure there are no judgments outstanding and that they have a reputation for payment of suppliers. Insist on cash on delivery payments for a short period of time to develop a relationship and to build a level of trust. Ask for contact details in their accounts department so you know who to contact when you need to get paid. Set and enforce your own credit terms. No point in having credit terms if you don't enforce them. Seek payments by direct debit or standing order. If you're short of cash, offer incentives for early payment of account to entice the customers to pay early. Phone your customers a week before payment is due to ensure there are no issues with payment. This is very important because you will iron out any excuses for non-payment before the bill is actually due to be paid. With slow-paying customers, phone constantly and get agreement on a payment plan. Impose penalties for late payments. After all, it's only good business when you get paid. Review your debtors on a regular basis. Know the balances outstanding and know that the information is accurate. On an annual basis, use a customer review form to get up-to-date information on your customers. And don't forget to improve your own internal procedures. When we talk about internal procedures, we're really talking about removing any excuses the customer has for not paying you on time. We know all the excuses. Didn't receive the invoice on time, didn't receive all of the goods, the invoice arrived so late that it missed the payment run, the invoice never arrived, what address were you using, there was an error on the invoice. So it's important that we make that phone call 1 week before payment is due to ensure that we can iron out any excuses the customer might have for not paying you on time. Also, let's look at eliminating your own internal errors. By implementing best practice, you will speed up payments and minimize issues for customers. Accuracy of information is key, starting with the sales order process, which is something we'll look at again at a later stage. Invoice promptly and make sure you post the invoice to the correct address. Have someone sign off on the invoices to ensure all the information is correct and accurate. Keep your records up to date, so when you raise an invoice, make sure that you post the invoice to the customer's account straight away. I want to turn our attention now to how to improve managing your stock levels. Remember that overstocking is a poor use of cash, so you should review your stock levels on a regular basis. Know how much stock you need at any given time. Don't overstock and carry unnecessary buffer stock. Focus on reducing slow-moving stock. And look for alternative suppliers. Don't be dependent on one supplier. Similar to being over-dependent on one customer, being overly dependent on one supplier can be disastrous for your business if that supplier goes out of business, increase prices to you, or fails to deliver goods to you. The key question here is how much stock do you really need to carry? There's no exact answer, as it depends on the type of business you have. There will be an element of trial and error. A large outlet, for example, can look very sparse if it's minimally stocked. What impression would this create to a customer? Longer lead times might also lead to you overstocking, as you overcompensate for the longer lead time by ordering extra stock, which then increases the risk of stock becoming obsolete, or going out of date, or going out of fashion. Suppliers might have minimum reorder levels, which means that at times you'll have to order more stock than you would rather. Also, during the year you might be running sales and therefore have special offers, which means again you'll have higher stock than you would normally carry. Similarly, if your business is seasonal, you'll find that this peaks during the year when you carry higher levels of stock. Over time, through trial and error, through experience, you learn how to manage your stock that bit better. We're going to move on now and look at how to manage cash outflows. That is, the demands that are on your cash to pay your bills and your wages, etc. The first thing to do is to review and understand the demands that are on your cash. Prioritize the payments. For example, you might have to pay staff wages first, and rent to ensure that you have a place to work out of and that you have staff to actually do the jobs for you. You will have taxes to pay, loans perhaps to repay, and suppliers to pay. So it's important that we know the demands on our cash and who the priorities are to be paid first. Ensure your creditors ledger is up to date. So post all of your supplier invoices and overhead invoices as they come in. Reconcile your creditors before paying. Don't just pay on statement. Make sure that you're paying the right amount on time, i.e. maximizing your credit terms. Speak to creditors if you have difficulty meeting their terms and discuss payment plans with them. Put in place procedures so that you plan your payments to match when your receipts are coming in from customers. Try and improve your credit terms. Reduce your costs. Have a look at your utility providers. Can you get cheaper rates for phone and light and heat, etc.? And then the one thing that I recommend to all my clients is that they prepare a 13-week cash flow projection, which they update weekly. This gives them a window where they can see exactly what their cash will be like over the next 3 months, and they can plan accordingly if they find that there are periods where they will have less cash than expected. To finish off the presentation, I want to take a look at some warning signs that could help you spot when customers are running into cash flow difficulties or when you yourself are running into cash flow difficulties. Firstly, have a look at your own internal systems and procedures. Do you see a lack of controls? For example, are you not chasing down customers for payments when they fall due? Do you know your bank balance on a daily basis? Are you aware of customers who are slow at paying you? And if so, what are you doing about that to help them speed up payment and to ensure they pay you on time? Have you found that customers are paying you off on account in round sums rather than settling the full account with you? So for example, if a customer owes you €1,200, do you find that he's paying you €400 or €500? This is a sure sign that he could be entering into some cash flow difficulties, and it's something you need to address. Have you issued checks that have bounced? Or has a customer issued checks to you that have bounced? Are you constantly maximizing your overdraft facility? Do you find when you visit customers that their standards are slipping, that their premises might be looking a little bit run down? This could be a sign that they have little funds to be investing in the upkeep of their premises. Are you falling behind in creditor payments? Are you not up to date with your accounts? Are you aware of changes in your environment from new competitors, for example? How has your style of management changed? Have you become a little bit more autocratic rather than your usual self where you delegated duties to other staff members? So don't delay. Put in place the procedures now that will help you spot these warning signs. You might just find that you secure the long-term future of your business. Again, many thanks for listening. And remember, BMS accountants are there to help small to medium enterprises just like yours in the Leinster area. So if you think we can help you, please get in touch. The details are on this slide. Thank you.
That was our video on managing your cash. I hope you got some benefit from it and some tips as well. Remember the critical elements. Ensure that you have a robust credit control policy to ensure that you only take on customers who are going to pay you. After all, it's only good business when you get paid. Make sure that debtors pay you on time. Don't overstock. It ties up cash, and badly needed cash, to maybe invest in future projects. Ensure that you maximize your credit terms. Know your bank balance. And be familiar with what's going through your bank account. Don't just leave it to your accountant or some member of staff. If you did enjoy the video, please subscribe to our YouTube channel. Like our Facebook page. Visit us on www.bmsaccountants.ie. If you're a business in the Leinster area, why not give us a call 046 907 3868 and speak to one of our staff. Next week, I hope to be able to put together a video which will show you how to construct a 13-week cash flow, which will help you actually visualize the position of your bank balance over a 13-week period or a 3-month cycle. So until next time, thank you very much for watching. Take care. Bye.